The US market closed in the red yesterday, dragged down by the Nasdaq 100, which shed by almost 2% due to fears in technology stocks, driven again by AI-related fears. Only the defensive sector within the US stock market managed to close in the green, which is the which is the healthcare and the utilities sector. However, the US dollar didn't created a significant movement yesterday and continues to trade below its 20-day moving average as depicted by the US dollar index. Over in Asia, deflationary fears spike up in the Chinese economy, where housing price index decelerated by almost 3% in January, worse than expected, creating a negative feedback loop on the Hang Seng indices. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Before we kickstart the gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay, so as usual, let's have a quick recap what has taken shape yesterday in the relevant broad-based cross-asset intraday performance and its relevant news flow / economic data. So let's start with the state of the US stock market. All right, let me expand my screen. Great. So I could see a sea of red among the major US stock indices. And what's interesting over here is that at the start, there was a rally in the first hour of the US trading session that is between 10:30 p.m. to 11:30 p.m. However, that initial momentum dissipated, and very clearly that later I'll share the intraday chart of the three major US stock indices that we cover on a frequent basis, which is the US Wall Street 30, representing the Dow Jones, the SPX 500, and the Nasdaq 100. All three of them try to rally close to the first resistance, which we highlighted yesterday. Then thereafter, it dissipated and it can't maintain the upward momentum in the first hour of the trading session yesterday and continues to slide in the red and close near its session low. All right, so that actually represents a rather bearish momentum throughout yesterday's US trading session. So the main culprit over here was dragged down by the technology stocks related to AI. The Nasdaq 100 is down by negative 2% over here. So if you look at the heat map of the S&P 500, very clearly we see a sea of deep red within the technology sector, and within this technology sector is being segregated according to sub-industry. Semiconductor pretty much was NVIDIA down by negative 6%, and Broadcom down negative 3%, and even Apple, that is not really a pure AI play right now, is down by a whopping negative 5% over here. That if we were to look at the groups basis based on the 11 different sector within the S&P 500, only the defensive sector managed to outperform with a positive gain. Consumer defensive, which is considered as consumer staples, like like Walmart would be one of them, up positive 1.44%, and utilities up by 1.23%. The rest of the other 9 sectors continues to trade deeply in the red, where we see also 2 other defensive like real estates, which is REITs, and healthcare marginally lower by negative 3.1% and negative 0.43%, that outperformed the S&P 500 and the other 3 major US stock indices. So overall, yesterday was a kind of a risk-off day in the US stock market. But this risk-off day in the US stock market didn't lead to a spike up in the US dollar over here. So if you look at the US dollar performance based on the 5-day rolling performance, what we could see is that the dollar continues to trade in a very sideways range over here based on the last 5 trading session. It's a rolling 5 trading session. And the weakest so far will be the dollar yen, that is still down by negative 2.6%. And if you look at from a 1-day rolling performance basis, taking into account of the last 24 hours so far. As of now, Singapore time, 13th of February, 11:09 a.m. Singapore time, we see a pretty much a flattish movement across the board. All right, and if you look at the US dollar index technical chart over here, so this is a daily chart of the US dollar index. It continues to trade below this downward sloping 20-day moving average. Now acting as a near-term resistance at around 97.37. Okay, let me put it in red for you guys to see. Okay, over here. Okay, so rather a lackluster movement in the US dollar yesterday. That means the US dollar index didn't actually caught a bit at all, despite the risk of environment that is being seen in the major US stock indices yesterday. So what I could see right now is that we have 1, 2, 3, 4, 4 consecutive session since Tuesday. Yeah, 1, 2, 3, 4. Yeah, 4 consecutive session of very small little candlestick body, i.e. more like a kind of a consolidating with a very tight range in the last 4 sessions for the US dollar index. But overall, the trend is still pointing towards more on the bearish side potentially, given that it still managed to cap below this downward sloping 20-day moving average, where it did a bearish reaction previously on last Friday. Now I think as an intermediate resistance at 97.38. And the top of the resistance will be the 50-day moving average, which was the bearish reaction high on last Tuesday and Friday at around 98.05 over here. So overall, the US dollar still remains resisted by a bunch of resistance that I highlighted earlier, 97.38 and 98.05, as we head into today's rather sensitive risk event day, which is the release of US CPI data thereafter. So later I'll share with you what will be the timing that could impact the movement of the FX market pretty much significantly, potentially. So if you overall, if you look at the CME Fed Watch tool ahead of today's release of this key US CPI data that is out later, market participants is still expecting no change to the Fed monetary policy stances in the upcoming 18th of March 2026 FOMC meeting to remains on hold at 3.5% to 3.75% for the Fed funds rate. That means 92% probability based on the Fed funds futures trading Fed funds futures trader trading behavior in the Fed funds futures market is expecting the Fed to stamp it on 18th of March. And if you look down further down the calendar, market is still looking for at least 2 interest rate cuts before 2026 ends. So we do have a high probability or high chance, as implied by the Fed funds futures market, that the Fed may introduce its 4th interest rate cut in this ongoing interest rate cut cycle that kickstarted in the later part of last year, at 78% chance on the 17th of June 2026 FOMC meeting, and the 82% chance on 29th of July 2026 meeting. So no change at all in the last 24 hours or so in terms of the Fed funds rate cut expectation, as implied by the Fed funds futures market. And thereafter, the potential 5th cut may come in on the 16th of September 2026 FOMC meeting, with the 71% chance and a higher chance of almost 100%, 99.5, on the 28th of October 2026 FOMC meeting. So net overall, by the time the year ends on the last day of the last meeting of the year, which is on for this year, which is on the 9th of December 2026, market participants is expecting a 68% chance that the Fed funds rate will be at 3% to 3.25%. So that actually implies that the market participants still is looking for a rather Fed, a kind of a Fed that is still continuing its interest rate cut cycle, but not so urgency. The urgency is not there, where the market going to price in at least 2 interest rate cut to come into the later part of this year, and the most earliest will be the summer months of this year, which is either in June or July. All right, so no change in the trajectory. That actually explained to us why the dollar index doesn't gain significant strength yesterday, due to the fact that even though we see a risk-off environment in the US stock market on the intraday basis yesterday. All right, and over in Asia, over here, we see the new house there was a tier 1 data in China, which is we call it newly built house prices index. So China new home prices across the key 70 cities fell 3.1% year-on-year in January 2026, deepening from a 2.7% decline in the previous month of December. So this latest data marked the 31st straight month of contraction and is the steepest drop since June. So what I could see over here is that market participants expecting a shallower decline of -2.7%, but it came in at -3.1% year-on-year. So if you look at the chart of this new home house prices index on the 10-year trend, it seems to be that it's kickstarting a continuation of this deceleration movement since August 2025 last year. So net overall, it means that there is still some kind of deflationary risk spiral that is rearing its head again in the Chinese economy, that actually created a negative feedback loop today in the China related markets, which is the Hang Seng indices. So if you look at the Hang Seng indices right now, it's actually down by -1.6%. And if you look at the CSI 300, which is a broader base of benchmark China A-share stocks listed in both the Shenzhen and the Shanghai stock exchanges, down by -0.5%. And the China A50, a narrower benchmark index for the A shares listed in the China Shanghai Stock Exchange, down by almost the same magnitude, -0.46%. And that created a negative feedback loop into the rest of the other Asia Pacific stock market. The ASX 200, which is the Australia benchmark stock index, down by -3.2% as we're speaking, trading near the session's low right now. Singapore STI also down by -2.4% after hitting a fresh all-time high yesterday, which managed to breach above the 5,000 psychological level. And we also see a sea of red in Malaysia, Indonesia, Thailand, and the one that is showing a shining star will be the Korea Kospi 200 index that's managed to trade positive at near the session high right now at 0.49%. And what's interesting over here is that the Nikkei 225 on the cash market is trading down -0.72%. But if you take into account of the negative movement that was seen in the US session yesterday, because they also came down in line with the broad-based risk-off scenario in the US stock market, the Nikkei 225 futures, which managed to capture yesterday's US lackluster movement as well, managed to show signs of a recovery. So in fact, the Nikkei 225 right now, as we are speaking, taking into account of the US trading session as compared to the cash market, which is closed in the US session yesterday, there's some signs of recovery taking shape, which is right now up by almost 1%, 0.98% as we are speaking, 11:17 a.m. Singapore time. All right, so that covers the first segment of the daily dose, which what causes this significant market movement. So let me now take you through the second segment of the daily dose, which is the intraday technical outlook segment. All right, so let me expand my screen. Okay, so let us kickstart with the FX market over here. Okay, starting with the euro dollar. So the euro dollar, no change since the start of the week. It managed to get congested within this two range. The key support level at 1.1840 over here, with the rising 20-day moving average coming very close to it as well. Near-term resistance will be this Monday high, which is this week high at 119.27. So it was tested on Wednesday, but can't break above it before it goes into a rather choppy sideways range, tight sideways range configuration again. So with that, I'll be watching very closely 118.40 as my short-term pivotal support level, which also confirms the rising 20-day moving average over here, having a mild bullish bias for it to retest potentially 119.27. Only a clear bullish breakout above 119.27 and the hourly close above it will potentially trigger a much more pronounced intraday bullish momentum to potentially seek out the next intermediate resistance level at 119.93 in the first step, which is the minor swing high area of 28th of January and 29th of January. However, if we have a bearish breakdown and the hourly close below 118.40, then this bullish bias view will be negated to see a choppy downward drift to expose the next intermediate support level at 117.76, which is the minor swing low of 3rd of February and 6th of February. Next up will be the sterling against the dollar. So the sterling dollar also trade in this sideways range over here. So still holding above the testing at the 20-day moving average, holding above our pivotal support that we have previously at 135.88 over here. So today I will have a rather tight resistance level on the lower time scale, which is yesterday's US session high at 136.67 that previously got rejected on the Wednesday US session as well. So it seems to us there's some hesitant at around the 1.3667 level. 3667. Okay, and if this 136.67 over here, so this will be my first resistance level to watch out for today. A breakout above 136.67 may trigger off a much more pronounced intraday bullish momentum, potentially to revisit the key minor resistance zone, which is a congestion area that was formed previously on 29th of January to 30th of January, got tested again on 4th of February before kickstarting this last leg of minor corrective decline previously, where it hit a bullish reversal low on the previous Friday, which is last Friday, 6th of February. So that will be at 137.30, 137.50. However, a bearish breakdown below 135.88 will invalidate today's bullish bias view to see it sliding lower to retest the previous Friday key minor bullish reversal low at 135.08 that also confluence with the rising 50-day moving average as well. All right, next will be the Australia dollar over here. So the Australia dollar can't break above our first resistance level, where it tested 3 times since Thursday at 1 a.m. Singapore time, tested again on Thursday 10 a.m. Singapore time, and tested again on Thursday during the start of the US session at 9 p.m. hour mark. So it seems to us that there's a bit of hesitance by the bulls to push above 71.40, which indeed a first resistance to watch that we highlighted earlier. But however, it managed to survive above our 70.65 pivotal support that we have so far. So we will still maintain that mild bullish bias using 70.65 as my short-term pivotal support level in order for the bulls to gain better traction or a increase of the intraday bullish momentum. For sure, it got to break up above 71.40 fast. So with an hourly close and a bullish breakout above 71.40, potentially the next intermediate resistance may come in at 71.75, 72.10, 72.19, which is a bunch of Fibo extension cluster level. Only a bearish breakdown below 70.65 and the hourly close below it, that would invalidate the recovery scenario for today to retest 71.40, but instead we'll see a start of another round of corrective decline sequence on a minor time scale to revisit the psychological level of 70 cents, which is at 69.98 / 69.78, which is so very close to this dotted green line here, which is the former minor descending trend line from the high of 29th of January, now turns into a pullback support. And if you look at this ongoing bullish impulsive upmove sequence from last Friday bullish reversal low of 6th of February low, all the way up to the high of yesterday's US session high at 71.40, that also confluences with the golden ratio of 61.8%, which is at 69.98, 69.78. All right, so that's for the Aussie dollar. Next will be the dollar yen. So dollar yen continues to trade lackluster, where the hourly RSI continues to shape a bearish reaction from this former dotted red line here, which is a former minor ascending trend line, now turns into a pullback resistance and started to form a lower high as we are speaking right now at 11:23 a.m. Singapore time. So this indicating the lack of upside momentum on the intraday basis, and this occurrence occurred right exactly at our Titan pivotal resistance that we highlighted yesterday at 153.85 over here. So we'll still continue to maintain a bearish bias on the intraday basis, as long as 153.85 key tighten short-term pivotal resistance holds for now on the dollar yen. First support level to watch out for today will be yesterday's minor swing low area that has been tested twice at 11 a.m. Singapore time and also during 12 a.m. Singapore time on Friday, which is as the US session gets underway. So that will be at 152.54. All right, 152.54. Okay, let me put it in writing. Breaking down below 152.54 may expose the 23rd and 29th October 2025 swing low area at 151.90, 151.60. Only a bullish breakout and an hourly close above 153.8, 153.85 will invalidate today's bearish bias view to see a squeeze up or the start of a corrective rebound sequence, a minor time scale one, to revisit 157.73 and potentially above it may seek out 155.66, which confluence with the downward sloping 20-day moving average. All right, so that sum up the dollar yen and all the other three major US dollar pair. Let us now proceed to the major stock indices over here, expanding my screen. All right, starting with the Hong Kong 33. So the Hong Kong 33 broke down below the 20-day moving average and so broke down below our pivotal support that we have yesterday around the 26,600, 26,580. So right now it's enrolling to retest last Friday key bullish reversal low and also correspond very closely to the 50-day moving average as well. So hourly RSI has really hit the oversold level over here. So with that, we will turn into a neutral distance for today. So neutral between 26,285 and 26,905. So this weakness, as I explained earlier, is being triggered by that rather worse than expected new home prices that has been released earlier this morning at 9:30 a.m. Singapore time. Indicating that there's a renewed deflationary risk creeping out from the Chinese economy. Only a bullish breakout above 26,905 will potentially see a resurgence of an intraday bullish tone coming back into the Hong Kong 33 with the next resistance level to watch, which is the major resistance level at 27,500. All right, so next will be the Japan 225. Which represent Nikkei 225. So Japan 225 now starts to recover over here, where we start to see the hourly RSI shaping a bullish divergence before exiting out from its oversold region. Right, let me go down. Right, there's this slight bullish divergence where price action trade similar low. All right, at our pivotal support, which is at 56,990. So tolerate a bit of excess during yesterday's US session, which is 56,534. Give me 56,534. Yeah, correct. Okay, slash it 534. Okay, so using 56,990, 56,534 short-term pivotal support level, maintain a potential mild bullish recovery on the Japan 225. First resistance level to watch will be 57,934 for today on the intraday basis. 57,934. Okay, above it, potentially seek out 58,932 next, which is a Fibo extension cluster level over here. However, a bearish breakdown below 56,990, 56,534, then potentially we may see another leg of minor corrective decline unfolding, exposing the next near-term support level at 56,096, followed by 55,111, 54,790, which is pretty key over here, which is a key pullback support level in order for, and also a potential bullish inflection point to see another round of bullish upleg if price action float down to here with some signs of positive technical element appearing thereafter, because it's confluence with the rising 20-day moving average. It also confluence with the former all-time high area that was previously formed on 14th of June, 15th of June, got rejected on 3rd of February and 4th of February before that bullish reversal take shape after last Friday bullish reversal low. Right, so that is a key pullback support at 55,000 111, 54,790. Right, so that's for the Japan 225. Next, we will have the Germany 30 that's representing the German DAX. So German 30 also yesterday during the European session is squeezed up again, hit our resistance zone at 25,100, 25,260 exactly before it trade on a weaker basis in line with the sell-off that's being seen on the broad-based US stock indices across the board yesterday. So that took shape between 11 p.m. Singapore time all the way down towards 12 a.m. and 1 a.m. Around 1 a.m. Friday time before the futures market closed on the German DAX, pardon me. So we managed to survive so far at our first support level, which we highlighted as well at 24,882, which is the 20-day moving average. So given that it can't break above this 25,260, I don't want to tighten my pivotal support to be so tight at 24,882. So pivotal support still remains the same for today at 24,610, which confluence with the rising 50-day moving average. So unless we have a clear recovery today and where price action starts to surpass our first resistance zone where it got stuck at, got a bearish reaction yesterday, which is at 25,260, then I would tighten my pivotal support level to 24,882. So for now, level still remains the same, keeping a mild bullish bias so far. Mild bullish bias given the fact that the hourly RSI continues to be held above this parallel ascending trendline support as well since hitting the oversold region on 29th of January. So maintain that bullish bias with the upside trigger level at 25,260. Above it, potentially seek out the current all-time high area of 13th of January at 25,505. However, if we start to see a bearish breakdown and the hourly close below 24,610, then this bullish recovery view will be invalidated to see it sliding down lower to retest this potential double bottom low that has been formed on a minor time scale from 2nd of February to 6th of February at 24,250 over here. All right. Next will be the major US stock indices, starting with the Dow Jones Industrial Average, so which is the US Wall Street 30. So it broke below our Titan short-term pivotal support at 49,940. So at the start of the US session, it attempted to retest our first resistance level at 50,532, can't break above it for the third time. So it printed a high of 50,460. So this is the third time yesterday, Wednesday, and as well as on Tuesday. All right, 3 consecutive sessions can't break, and it broke below our short-term pivotal support level at 49,940 at the 12 a.m. mark yesterday, which is early Friday session before trading lower and form some form of stabilization at the 20-day moving average. So with that situation over here, and a rather mixed element, because right now we see this stabilization has started to form a bullish divergence on the hourly RSI, where price action inched down a slight lower low, but a higher low on the RSI. So with that, I will have a neutrality stance for today, given that it's coming very close to a 20-day moving average. If we were to actually bounce from here, we may start to see another round of recovery again from the S&P 500. So it seems to us that this S&P 500 every Thursday there seems to be and Wednesday there seems to be a rather erratic intraday downside movement before recovering on Friday. That actually took shape on last Friday. So what we have is that I will have a neutrality stance for today. So watch between these two levels, 49,940 and 49,265. A clearance above 49,940 will allow the US Wall Street 30 to escape this yesterday's bearish sentiment and potentially seek out a retest at close to 50,532. Only a clear breakout above 50,532 will increase the odds of another bullish impulsive upmove sequence, potentially towards the next resistance level at 50,695, 51,033, 51,182. However, a bearish breakdown below 49,265 will see this ongoing minor corrective decline sequence unfolding further to revisit 48,900, 48,713, which confluence with last Friday key reversal low and also the rising 50-day moving average. Next will be the SPX 500. So the SPX 500 also collapsed below the 50-day moving average yesterday, and we will flip to a neutrality stance for now. So neutral between 6887 and 6818. Only a bullish breakout and hourly close above 6877 will allow the SPX to escape from this ongoing bearish momentum sentiment on the intraday basis to revisit yesterday's intermediate resistance zone, which was being formed yesterday after it broke down this zone where we kickstart a series of hourly bearish candlestick that is at the 11 p.m. Singapore time yesterday. So that will be at 6,916, 6,916, 6,932, 32. All right. Over here. However, a bearish breakdown further below 6,818 will see further potential weakness towards 7,697, 7,769, which is very close to the last Friday swing low area as well. So that's the SPX 500. So the weakest was the Nasdaq 100. So the Nasdaq 100 managed to survive at our short-term pivotal support level because we have a very wide short-term pivotal support level on the Nasdaq 100, given the wild intraday gyration that is being seen on the movement on the Nasdaq 100. So our flip to a neutrality stance for today as well on the Nasdaq 100, neutral between 24,700, 24,580, which was yesterday's short-term pivotal support zone. Upper limit will be the trigger level that triggered the series of hourly bearish candlestick that took shape on 11 p.m. Singapore time yesterday, which is at 25,085. Only a bullish breakout and hourly close above 25,084, not 85, 25,084 may potentially remove the intraday bearish momentum sentiment that is inherent right now on the Nasdaq 100 to potentially retest the 20-day and the 50-day moving average resistance area, confluencing at 25,430, 25,580. However, a bearish breakdown below 24,580 will see further weakness to drift it downwards towards 24,333, 24,142, which is the key reversal low of last Friday, 6th of February. All right, so that's for the Nasdaq 100. Next up will be the commodities market over here. Very quickly, we'll go to Gold XAU/USD. So gold yesterday, we do have a bearish bias for it to potentially float back down towards this kind of rangy configuration. So it hit almost at the top of the range below 5,170 short-term pivotal resistance level, plunging down, hitting 4,940 around the 20-day moving average before shaping a bounce over here. So given the fact that the hourly RSI continues to shape a series of lower high over here, we could see. So we will still maintain that bearish bias for sure, given that it can't have a proper breakdown below the 20-day moving average. So I don't want to tighten the pivotal resistance to be so tight. So maintaining it at 5,170 short-term pivotal resistance level. First support level to watch out for today will be yesterday's intraday low that managed to survive during the Asia session today as well at 48,898 as we're speaking. A breakdown below 48,898 potentially exposes the minor swing low of last Friday at 4,795, 4,703. Only a bullish breakout above 5,170 and hourly close above it that would invalidate the bearish bias within this rangy scenario to see a squeeze up towards 5,448, which is the minor swing high of 30th of January in the first step. Excuse me. Next will be the West Texas crude oil over here. Give me a minute about the chart. Okay, so this is the West Texas crude oil. So the West Texas crude oil did a very choppy movement yesterday. So didn't actually hit our resistance as intended, and it broke all the way down below our Titan pivotal support earlier at this 63.35 over here. So the RSI now is at the overbought level, oversold level already over here. So given said as oversold level, and the price action managed to survive exactly at the next support level at 62.38, which is so confluence with the 200-day and the 20-day moving average. So with such mixed element, I will have a neutrality stance for today. So neutral between this 62.38 over here. Let me put it in writing. Oops, sorry. Okay. and this area here that can't have a proper breakout, which confluence with the minor swing high of 5th of February. So that was a Wednesday's high at 65.62. 65.62. All right. So neutral between these two areas, these two levels, 65.62 and 62.38. However, if we have a bearish breakdown below 62.38, then further weakness may ensure or may unfold on the West Texas oil for it to expose the next intermediate support zone at 61.12, 60.64, which confluence with the congestion area of 27th of January and also the swing low of 3rd of February, and coming very close to the rising 50-day moving average as well. All right, so that's for West Texas oil. Flipping to a neutrality stance for now, 65.62 and 62.38 over here. All right, so that sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the calendar. What are the key data to look out for other than the US CPI data, which is out later at 9:30 p.m. Singapore time? So very quickly, today will be Friday. Okay, let me close the calendar. Okay, so for Friday, what we have during the European session, we do have PPI data, or we call it wholesale prices data for Germany at 3 p.m. Singapore time. That will be potentially coming out. What we have on a year-on-year basis, it will be a lower number as forecast by Trading Economics, 0.6%. From 1.2% year-on-year that was printed in December. So that could potentially influence the euro dollar and the euro crosses, and in some form the Germany 30 index, the CFD index over here. And going forward over here, this is where the all important 9:30 p.m. US core inflation data. So for US core inflation data, if you look at on the month-on-month basis, the consensus is expecting a slight uptick to 0.3%. But if you stretch it out, removing off the seasonality factor on a year-on-year basis, market is expecting a slight dip to 2.5% to 2.6%. So if it continues to hold around what market consensus, especially on a year-on-year basis, and then expand further towards like 2.7 or 2.8%, potentially the dollar strength may still remains muted, as explained or highlighted on those key technical levels on the major US dollar pair earlier on. All right, so then thereafter will be almost a very quiet US session, all right, over here, because there's no other key data to look out for. So with that, let's sum up today's Daily Dose of Market Insight. I wish you all a great day ahead, and as well as a restful weekend, and we shall speak again on Monday. Thank you.